Rajesh Palviya, who is now joining in on the technicals, is with us on the show. Good afternoon, Rajesh. Let's first talk about the index. After the ferocious rally that we witnessed, the terrific start to the new series, we are holding out. You do have support coming in from the likes of Metal, Select IT. But do you sense that the kind of fervor that we witnessed is absence, and that we will touch the all-time highs perhaps, but it might not be with that much conviction in terms of sustaining around those levels?
Yeah, good afternoon. Yeah. If you look at the indices, if we talk about the Nifty is, now confidently holding about, 11,900 level, and looking at the kind of, buying action at the higher level, we feel that, sooner or later will able to cross the all-time high level. But if you look at the derivative data, the highest call concentration is existed around 12,000 strike price. So once we able to cross this 12,000 level, then yes, possibly we can see the higher level of around 12,100, 12,200 level in the November series itself. So on the any dip is buying opportunity at the current juncture, and looking at the current data, the important support area for the Nifty is existed around 11,850. So any minor dip or any corrective action is a buying opportunity. One can keep stop loss of 11,820 for any buying position in the indices as well as in the market. And on the higher side, we are expecting that 12,000, 12,100 level can be seen in the near term basis.
Okay, Jay, what are you looking at this afternoon then? How are markets trending according to you?
Very good afternoon to you, Abba. I think that yes, 11,800 will act as a very crucial support for this series. In fact, Abba, I would like to compare this to the last series. In fact, I would say wherein 11,700 initially was acting as a very crucial resistance, wherein we had a good amount of call writing then. And once those levels got taken off, then we saw Nifty in fact inching towards 12,000 level, which was the next resistance where we had seen the highest open interest. Now in this series as well, in November series, as Avan just mentioned that the start has been quite good on the positive side, but there is one hurdle at around 12,000 levels. I think once that hurdle gets taken off, the momentum would thereafter would be quite smooth. I would say till the levels of 12,200 to 300. Till that happens, I think Nifty can trade within this band of 12,000 to 11,800. Some consolidation can be seen before we break out about 12,000 levels, but overall momentum is positive. Hence, the probability of a breakout on the upside is quite high. So bulls have an upper hand right now.
Okay, that's the word on the technicals of the trading day, but here's a word from Harsha Upadhyay, the Chief Investment Officer, Equities at Kotak AMC, who advises investors to avoid taking risks as the market fundamentals raise caution. He remains quite bullish on two-wheelers as well as insurance companies.
Sentiments have improved and liquidity has also improved post the tax rate cut announcements. Having said that, the fundamentals will take time to really start showing better numbers. So to that extent, I think it's going to be a consolidation phase. One needs to be cautious that it will take time for fundamentals to improve, and hence look at it as more of a investment phase rather than trying to really take more risk and look for short-term gains. Mid and small cap basket is clearly giving more relative valuation comfort, and that's where you will probably end up making more money than the large cap over the medium to long term. We have invested quite a bit of our portfolio corpus into chemicals over the last year or so, and continue to remain very, very positive on this space. We do own insurance companies at a point of time where some of the lending businesses have got completely disrupted. I think from a penetration perspective and what kind of growth trajectory can be there for some of these companies over the long term, there is absolutely no debate. So one needs to be a little cautious about the valuations, but otherwise I think these are very good businesses to be invested into. Slowly the private capex should also come up, not immediately, but once the capacity utilization levels will move towards the 80%, which may take maybe 24 to 36 months. But until then, there is enough economic activity that is happening in the country backed by the government capex, and that's what is going to drive some of those demand numbers for core sectors in our opinion.
Welcome back. Still tuned into closing trades, holding out in the green. And yes, there's stocks like Infratel, JSW Steel, Vedanta, as well as Bajaj Finserv and UPL that are having quite a terrific run. But today there's outperformance being seen by the small cap index, while on the frontline index, as we're counting down to those all-time highs, we're currently perched at 11,931. But let's keep you up to speed with more news and updates as well. And the Supreme Court has rapped the central and Delhi government on their failure to cope with the rising air pollution in Delhi. My colleague Abhimanyu Sharma joins in with the latest details. And Abhimanyu, it's a pretty terrible situation out there. What exactly is the latest that we're getting from the Supreme Court?
Well, the Supreme Court has come down heavily upon all the state governments around NCR and also the union government. It has observed today that the state governments are responsible for stubble burning and pollution. They need to be made liable. It has also observed that the state governments are only interested in electioneering, which has made a mockery of everything. And experts have been called by the Apex Court. Center has been asked to bring experts to the Apex Court from IIT Delhi and the Union Environment Ministry within 30 minutes and suggest immediate steps to tackle air pollution in Delhi. Remember, today onwards, till the 15th of December, the odd-even vehicle rationing scheme is already in place in Delhi. And the Apex Court has observed that right to life is most important, in which many people are losing precious years of their life due to air pollution in Delhi. It cannot be allowed to carry on in a civilized country, since no room is safe to live in the city, not even within houses. And the city has been choking like this every year at this point of time, just after Diwali, and the governments have not been able to do anything much. The court has observed that people can't survive in Delhi if the issue of pollution isn't resolved, and experts would come to the Apex Court soon. They are going to suggest immediate steps, over which it's likely that important orders would be issued from the side of the Apex Court, not only to the center but also to various state governments, in order to tackle pollution on an immediate basis.
Thank you for the update. Abhimanyu continues to be a burning issue there in the capital. Let's get some trading strategies then. At this hour, we've got Jay, Rajesh, both with us. Jay, let me start off with you then in terms of picks. What would you recommend this afternoon?
My first buy recommendation is on Biocon. Now, this stock has clearly provided a breakout. I would say the momentum is absolutely positive, and the way the stock has taken off its previous swing resistance of around 260, I would say going forward we can see the levels of almost 280 out here in the very near term. With a stop loss of 257, one can buy this ABA, as the stock has provided a very good breakout from an inverse head and shoulders pattern. So that's my first buy recommendation. The second buy recommendation is on Hindalco. Now, Hindalco is forming a good inverse head and shoulders pattern. In fact, in the morning I had provided another two metal stocks, that is Nalco and JSL, and both are up by almost 3 to 4%. Hindalco too is looking quite positive. I would say it has also formed a nice inverse head and shoulders pattern. The indicators are absolutely positive out here, and we all know that metals are now trending. So Hindalco can be bought positionally for a target of 210 with a stop loss of 193. Well, about the third buy recommendation is on SRF. Now, this stock has been consolidating since a couple of months now, and in today's trading session, we have seen a breakout above the downtrend line resistance. The probability of SRF now, inching towards its lifetime high is quite high from these levels. However, for the short term, I would say SRF can be bought for a target of 3100 to 3150. That's a good target in the short term, I would say. And the risk reward is absolutely in favor of the bulls. And the stop loss is at 2850. So it's 1:2 to 1:3 risk reward on SRF, and this stock is quite in momentum. And the final buy recommendation would be on Bank of Baroda. We have been seeing that last week all the PSU stocks were quite in momentum, and SBI was leading, of course, but then other small and mid-sized PSU banks were also moving quite well. Bank of Baroda especially, I would say, that has formed a nice falling wedge pattern on the monthly charts. This stock has formed a nice hammer candlestick pattern. The indicators or oscillators are providing a good buy crossover with a positive divergence, and even if this stock manages to retrace 38% of its entire fall, then it will inch towards 124. It's a big positional call, I would say. Trading at around 102, one can place a stop loss at 92. However, the target is 124.
Rajesh, what about you?
Yeah, I have two buy recommendation. First one is ONGC. If you look at the structure of ONGC, stock managed to give breakout of last 15 trading session consolidation on the daily chart. Even if you look at the weekly setup, stock managed to give the down sloping trend line breakout on the weekly chart. And on the derivative side, again stock has gained around 9% kind of open interest addition we have seen in the throughout the session. So looking at the breakout, I feel that ONGC can scale up towards the level of 156 to 158 at from the current level. So one can buy ONGC with stop loss of 145. The another buying recommendation is from the metal pack. We have seen whole metal sector is performing well in the today's trade also. And looking at the breakout on the JSW, still I feel the stock has given the breakout on the weekly as well as on the daily chart, and stock is trading above all its important moving average. So looking at the pattern as well as the stock has gained around 4% kind of open interest, and long addition has been witnessed on the derivative side also. So I feel that stock can really towards 260 264 in the near term basis. So one can buy JSW still at the current level with stop loss of 247.
Ajay Bagga as well joins in with his take on the markets. Ajay, so far so great, but has the time come, if not before, to now finally start increasing your allocation to mid and small caps?
Well, yes, I would say yes, but the but is that the economy will take time to recover. Today we had the Fitch chief economist talking about multiple years before the Indian economy comes back to 7% kind of growth levels. My own assessment was maybe we are 3 to 4 quarters away from a good uptick in the economy, depending on a lot of other factors, of course. The markets are front-ending that economic...
Ajay, just stay with us. We've got HDFC's numbers coming in, so I'm just going to come to you for a reaction shortly. 3962 on the PAT, while the ET Now poll was penciling in a figure of about almost 3470 thereabouts. We were expecting good numbers from HDFC any which way. Capital gains in group finance were to lead to higher profits. That was already accounted for in any case, and the profit on stake sale in group finance, that stood at about 1630 odd crore rupees. But even with regards to that, on a standalone basis, if I just have to exclude that particular gain, the PAT stands at 3961 crore rupees versus a comparable of 2467 crore rupees, and that definitely is higher than what the polls were actually penciling in. The profits were to degrow adjusted for gains. The dividend income, remember the Q2 dividend income, that stood at about 1074 crore rupees versus about 6 crore rupees in the same quarter last year. That's on a year-on-year basis. We're expecting a slight bit of pressure when it comes to NIMs, so let's wait by and see where they actually stand. While we are expecting a strong NII growth, and a stable one at that, as always is the case with HDFC, of roughly about 25 odd percent. Total tax expense, that stands at about 568 crore rupees for them this particular quarter. That's versus a comparable figure of about 1022 odd crore rupees on a year-on-year basis. I'm just going to wait by and see what the NII figure is really, because the PAT of course has come in a little higher than the ET Now estimates. Also want to see what really is the NIMS performance, because while we are expecting asset quality to remain largely stable, NIMS may actually dip on a sequential basis. So that is something that we're going to look out for. The retail loan growth, that is we're penciling in about a 17% growth over there on a year-on-year basis, and about a 13 to 15% total loan growth led by their retail business. Ashutosh, hi, afternoon. Analyze the numbers for us. I have the PAT figure with me, 3961 crore rupees. The total tax expense, which stands at 568 crore rupees, and the dividend income, which stands at about 1073 crore rupees.
Yeah, so number is above our estimate at this point of time, and if you look at when loan growth is also quite healthy, given the size of the HDFC Limited. Dividend income definitely in the second quarter, so they receive dividend from HDFC Bank in this quarter, which was already disclosed to the market, so that was the main reason for it.
Calculated NII as well, Ashutosh, and that has come in at 2,648 crore rupees. We were working with a figure of about 3,237. of course, this is without considering the income from loans sold.
Yeah.
Does it match
Yeah.
up with your estimates?
No, doesn't matter much because no, in India's we have reported names versus core names concept. So when we take income from the loans, securitized income, then probably it will be remain stabilized around the same thing. And for HDFC Limited, because it's NBFC, another most important things to watch will be the spread for them. If they maintain the spread in the same range, then there is no issue as such.
Okay. Ashutosh, let's just talk a little bit about what it is you want to hear as well in terms of the management commentary. Of course, their performance on the real estate sector, their outlook on margins and NPAs will closely be eyed. But what is the kind of commentary that you're expecting to hear?
So the most important things to watch will be the what is the status of their commercial real estate portfolio. And so HDFC Limited also have the exposure to the few of the names which is going around at this point of time. So what the management says about that, what type of provisions they have or they are planning to make on that, if there is any risk on in their portfolio, that will be the most important to look for from the management.
Okay, what's the outlook on HDFC? A fairly stable name. The numbers this time around as well haven't been too bad in terms of the quarterly performance. It has been a strong set of earnings, particularly on the profit front, as well as the revenues. Tell us what's the outlook on the stock price.
So given the whole mess around housing finance segment, we find the HDFC Limited to outperform the whole segment because two players is almost out of business. Okay, so that is really giving a good flip to the HDFC Limited in the terms of the choosing good quality business. But there are some issues on how really external linked benchmark, which the bank has already started offering, how that is really going to pan out. So what we expect to HDFC Limited for time being for another quarter or so till the time things emerge out, it will market performer, not the outperformer.
Okay, stay with us, Ashutosh. In the meantime, I'm going to take it across to my colleague Soumya, who tracks the earnings, to give us a report card of what HDFC has delivered in Q2. Soumya.
Well, Avan, talking about the net interest income, this was fairly below our expectations of 3,100 crore rupees, while the company has reported an NII, and that's what we've calculated as for now is 2,647 crore rupees. So this is below our expectations. On the profit line, there has been a jump, and it's above our expectations. Basically, this may be because of the tax benefit that the company has received. For this quarter, the tax expense has been at 568 crore rupees versus 1,022 in the last year. Not just this, in fact, talking about the provisions on a sequential basis, the provisions have dropped by over 15%. However, we've seen an increase in the provisioning on a YOY basis. I still do not have the NPA figure, which definitely remains a crucial factor as to what the NPA trends are as far as HDFC Limited is concerned, even though it's a very prominent HFC and we're expecting it to be largely stable. But as far as the asset quality is concerned, we do not really know what the NPA figure is. We'll be keeping you posted with it, but as of now, the profit line has been good, NI has been below. Let's see what the other details as and when they come out.
Ashutosh, let's get in a quick summary from you in terms of the kind of provisions that they have delivered in the quarter gone by, as well as your outlook on the dividend income, etc. for HDFC.
So on the provision front, we all know that HDFC have carrying a much of excess provision on overall enterprise basis, on enterprise level. So definitely a sequential decline in the provision, not too much of worry. But the important things to watch will be is there any stress emerging out of their commercial real estate, not commercial, the residential and some of the commercial real estate sector, which is widely discussed at this point of time in the market. So if there is any stress coming out, how the management is going to tackle that issue, that will be the key things to look for the future guidance on the credit cost front.
All right, thanks.
Yeah.
Okay, we'll let you go on that note, Ashutosh. Thanks so much for joining in and giving us your breakdown of HDFC's quarterly performance. Yet another steady quarter from the company, and that's the stock price at 21.57, reacting to its quarterly performance. Ajay, anything you'd like to add to that as to how you've read into the numbers?
Well, the NIMs are disappointing. They are lesser, and what we had really expected was a gain in market share at the expense of the constrained players who are not able to get funding, while HDFC is able to raise funding. So, would like to look through the commentary, and as your analyst was also saying, what is the wholesale book reacting like? The good thing about HDFC is that it's the market leader, is able has a very strong brand and is able to raise funds in any kind of environment. So they will gain market share overall. So on a longer term basis, it is a buy and hold for any portfolio, not cheap by any standards, but given the kind of treasures that it holds on its balance sheets in terms of its subsidiaries and its holdings in them, I think that's why the valuation is quite justified. Overall, one would like to look at what was the reason for the NIMs not growing as per expectation, and then the wholesale book, how is that performing? I think those will be the two big questions for the management.
Okay. The gross NPAs for HDFC, by the way, are out. They stand at 1.33% versus 1.29 on a sequential basis, and that is a minute bit of uptake. The net interest margin, though, has come in stable at about 3.3% on a sequential basis. The loan growth, that stands at 12%, so that's largely along the expected lines. Ajay, what is it that you're making of the news flow with regards to Yes Bank? Well, of course, the numbers have disappointed, but all this talk about suitors lining up their way, trying to pitch in almost about $3 billion. I don't know how much of it is going to really materialize, but it seems that they have the might now to raise funds.
Yes, it is a franchise worth holding for foreign investors. We will have to see, given the RBI constraints, given the open offer constraints, it's not going to be 51% somebody taking over without a lot of approvals that would be needed. So I would say be very cautious. The credit costs are a given that we understand, and maybe more write-offs, more slippages could be there. That is the word of caution. What is positive is if this fundraise goes through, and then the bank gets on a growth pattern again. That is very critical. But for the retail investor, I would say you have a lot of other opportunities, and let the special situation kind of investors look at this situation. Unfortunately, a lot of retail Indian investors have been trying to time the market and have been trying to and have been continuously buying Yes Bank across the last couple of quarters and more. I think that is sheer timing. I don't know if that will work out. I would be cautious on that. That's what I would say.
Okay, Ajay, thanks so much for joining us this afternoon. Okay. Let's also now welcome in the management of Jindal SAW. We've got Neeraj Kumar, the Group CEO and Whole-Time Director with us. Neeraj, what's the reason for the flat growth this quarter? Tell us about the average realizations and how they contributed to the top line.
One more quarter of consistent performance. If you see our quarter 2 performance and compare it to the comparable quarter last year, the performance is more or less flat. But if you compare the full first half of this year versus the first half of last year, there is growth. Now this is against a business environment where we are facing some tailwind, and during the second quarter we also had unprecedented monsoon. So a lot of pipes which were supposed to be laid, that got hampered because in monsoons, trenching and filling, it gets a little hampered. So flattish performance should give all of you the comfort that fundamentally we are very, very strong, but the monsoons and the tailwind that is now coming in the economy is, we believe, a temporary impact on Q2 results. Q3, Q4 we should catch up, and we are confident that the year end we should be able to meet our targets.
Now your margins have remained flat as well. What's weighing on them this time? Are there some input cost pressures that you've been seeing?
No, it's the other way around. In fact, you should see the margin in the second half improve, because there has been some easing of the raw material prices, but there is always a little bit of lag effect before those inventory gets consumed and it is converted into the finished goods and it hits your P&L. So second half you should see an improvement in the margin.
Good afternoon. I just wanted to understand, given the fact that we have seen a slowdown, most of your people in your sector have been impacted when it comes to order execution. Tell us, how has demand been for you this time around?
There are three important things. In the short term, what we are seeing is a little delay in the project execution, because some of the government funded projects are maybe starving for funds, or the funds are getting delayed. The second thing that we are seeing is even very large PSUs, some of them are Navratnas and Navratnas, they also, in terms of our collection, we see some liquidity pressure there. But overall, in the medium term, overall in the next year or so, we are very, very hopeful, because of the initiative that Government of India has taken, the Jal Shakti mission, which is taking water to every home. Now that gives us a lot of hope for our entire sector in terms of large DI as well as the HDPE pipes that we have begun to produce now.
Right. And how is it that you expect to do in FY20? Any volume sales targets that you may have set across your segments?
We have a healthy order book. If you see our order book, it's in terms of value terms in excess of $1 billion, in terms of quantity in excess of 12 lakh tons. And we do hope that some of these major initiatives of the government would start translating into orders. So we are very hopeful, because now fundamentally Jindal SAW has become very strong. We have dealt with most of our legacy issues. This quarter also you would see there have been some last bit of write-offs which was required, has been done. So the fundamental strength of Jindal SAW makes us absolutely confident that we are ready to take on whatever opportunity the market throws at us, and we would benefit out of it. So you should expect a very consistent and a good performance from Jindal SAW over the next few years.
To have you on the show. Thank you so much for highlighting the earnings. HDFC just delivered its numbers. Let's cut across to KK Mystery.
We had a total of 62,628 crore worth of loans which have been sold by us, but where we continue to service these loans. Our focus continued to be on affordable housing. Affordable housing segment continued to do very well. If you look at it in terms of number of new loans that we gave in this period, 36% of the loans that we gave in numbers were to borrowers who are either in the economically weaker section or in the lower income group. In value terms, this was 18%. So 36% in numbers and 18% in value were loans given to borrowers in the economically weaker section or in the lower income group. Every month we approve close to 9,500 crores, a little under 9,500 crores of loans to borrowers in the economically weaker section and in the lower income group. If you look at the average loan size, to borrowers in the economically weaker section, average loan size is 10 lakh and 10,000, that's 10.1 lakh. And to borrowers in the lower income group, our average loan size is 17 lakh and 50,000 rupees. The overall average of loans that we carry now is 27 lakhs. So we've actually seen a reduction in the number of, in the value, in the average loan size of loans given in the first quarter versus the second quarter. In the first quarter, the average loan size that we gave was 27.7 lakhs. In the second quarter, it was 26.6 lakhs, giving a total of 27 lakhs on an average for the 6 months as a whole. So the growth of 17% in the AUM for individual loans has to be seen in the light of the fact that this was on an average loan amount which is lower than what it normally would be, and therefore the volume growth was that much higher. If you look at the breakup of loans outstanding on a balance sheet basis between individual and non-individuals, 76% of the loans outstanding on a balance sheet basis were to individuals, 12% were construction finance, 8% were LRD loans, which is lease rental discounting loans, and 4% were corporate loans. So that's the breakdown on a balance sheet basis. However, if we were to look at this number incrementally, I mentioned to you in the last 4 or 5 press conferences we've had after the quarterly results that we are going slow on our non-individual lending. It's not that we stopped doing non-individual loans, we still are doing it, but we are doing it very, very selectively, very, very slowly. So if you look at the last quarter, the second quarter, 97% of the growth in the loan book was on account of individual loans, and only 3% was on account of non-individual loans. If you look at the 6-month period from April to September, it was 94% in respect of individual loans and 6% in respect of non-individual loans. As you know, for our subsidiaries and associate companies, we do not mark-to-market these investments based on market prices. We continue to carry these investments at historical cost. The difference between the market value of these investments on 30th September and the price at which these investments are reflected in the balance sheet was
of HDFC, Mr. KK Mistry, talking about the quarter gone by. By the way, just a little update on Zee Entertainment. Remember that the stock has been in focus throughout this trading session on the back of the news bit that VTB, according to reports, has sold pledged shares of the Zee promoters. But the management is now saying that they have completely denied that speculation on the share transfer as well to escrow, and they have been in dialogue with their prospective investors, which is something that they continue to maintain. Still continuing to hold on to the 295 mark. That is the entertainment for you. But in the meantime, it's been Infosys as well that's been in focus, as it's denied any wrongdoing. The company has clarified that as of now, there's no evidence to corroborate the whistleblower charges. Let's take it across to Pranay, who joins in with more details. Pranay?
Well, yes, Infosys has clarified that as part of its ongoing investigation so far, they haven't found any lapses in the corporate governance or their operational processes. Also, there is no supporting evidence that has come through as yet to corroborate any of those allegations which were made in the whistleblower complaints, whether it was regarding financial irregularity or not following the due process for the large deal signings, or even for that matter not reporting all the decisions properly. So no evidence has come forth so far. Also, nothing has been provided by the whistleblowers in their complaint to back those allegations, though they continue to investigate it with Amarchand and Mangaldas. What they are saying right now is that there will be some more details or updates that might come through from the auditors, and they will not leave any stone unturned. That's what the meaning of their statement is, to find out any lapses in corporate governance or operational processes and efficiencies. So on the back of this clarification coming from Infosys, you've seen a relief rally in the stock.
All right, now Yes Bank is in focus today. Ravneet Gill has said that offers worth $3 billion are on the table and that it's in discussion with various global investors. Meanwhile, of course, the numbers have also come in, losses to the tune of 600 crores on account of a one-time tax hit. Listen in to this exclusive conversation.
We are ourselves disappointed with the asset quality issues, which we definitely thought had stabilized. And but there's another way of looking at it as well, Nukunj. So if you see what has got added to the BB and below book, in terms of groups which are not already part of that, essentially it's just two, which is CNK and the CG Power one. Now, those were two corporates where the events that unfolded were very difficult to anticipate, and therefore you could not have budgeted. The second thing is that we did expect in quarter two to for at least two of the resolutions which are very high profile and which are in the public domain to have got done, and those were baked into our credit cost guidance, and I think that didn't happen. Thirdly, I think you would agree that if you look at the overall credit macros that are there around us, they continue to remain fairly sharp and fairly stressed. And if you see the three factors in conjunction, it would give you a sense in terms of why we have actually had an increase in NPAs. So that's number one. On the basis of that, we said, okay, fine. If you look at these three factors, then there was an error of judgment on our part in terms of giving our credit cost guidance, and we said that the credit cost guidance we were increasing by 125 basis points at the outside. But having said that, if I look at the concentrated exposures in our book, I would say that this pretty much ring fences all the legacy issues.
You still have exposure to real estate, you still have exposure to telecom. It is not that the economy has really come back and there is no V-shaped recovery. If at all, the economic growth is very anemic. So why are you so certain that we are nearing the pain? Because if the economy does not recover and the set sectors like telecom or real estate problems get added further, the downward trend could continue.
So on the one hand, I said that, if I look at my concentrated exposures where things could have potentially gone, or those now stand ring-fenced, if we have still provided a credit cost guidance of additional 125 basis points, I think it comes from the fact that we do recognize that sectors like real estate could see some pain, although we don't see that at this point in time. The names in our real estate portfolio which look to be marginal credits, I think have already been ring-fenced, either as part of the BB and below book or actually have been provided for. So I would say that it's very difficult to paint the entire sector with one brush. Overall, I think we're just keeping a very close eye as far as the real estate portfolio is concerned. As far as telecoms is concerned, my sense is that post the Supreme Court judgment, obviously there has been a little bit of disquiet that has come into the sector. But we equally know that the government has appointed a group of secretaries to look into this.
Cadilla, that's the stock which is in focus. They've received a warning letter issued by the US FDA. What is this pertaining to? Pankaj joins in with details on that. Pankaj?
So, Aisha, warning letters are never taken quite good by the market, even if the facility is important or not. But this one for Cadilla is the Moria unit, which is one of the most important unit that the company has. Now, does this come as a surprise? No. It was already classified as an OAI, and 90% of the times when a unit gets classified as OAI, which is official action initiated, you tend to get it converted into a warning letter. Now, the stock is down around 5-6%. It was already expected. 90 days have happened once the classification has happened, and that's the timeline within which US FDA has to classify this into warning letter. So it doesn't come in as a surprise that they have got it. What does it mean for the counter? It means that still the earnings will be subdued. There will be no approvals from this plant, and mind you, they have decent amount of approvals from this particular plant, and that's why we'll track forward this information as to how it gets lifted. We're trying to get in touch with management to get a comment on this warning letter, but warning letters are never taken nicely. It's an important plant. Their US business decently depends on this particular plant. Stock is down 5% as it was expected.
All right, that's the reason that the stock is down and out in trade today. A warning letter for their unit, 243 on the stock. Tell you what, we'll slip into a very quick break. Let's come right back for more market talk.
Okay, welcome back. Got Jay Thakkar with us as well as Gaurav. Jay, let's get your fix this afternoon.
About the buy recommendation which I have is on Ajanta Pharma. I think one can buy Ajanta Pharma for a target of almost 1120. The stock has formed a nice inverse head and shoulders pattern. One can buy right now at 1080 for a target of 1120 with a stop loss of 1055. Now the second buy recommendation which I have is on JSL Heiser. I think the stock is trading well around the levels of 74.50, 75 levels on the upside. The stock can go till the levels of 84. The stock has formed a nice bottom. It has formed a good rounding bottom pattern, and on the lower side, I think that 70 is now a very crucial support for this stock. The risk reward is absolutely in favor of the bulls, so one can buy JSL Heiser as well.
Okay, Gaurav, what about you? What's looking good to you today?
Good afternoon. The first recommendation would be on Bajaj Finserv. People generally talk about Bajaj Finance, but this is one name that is moving silently and very strongly to speak of. On daily chart, it is forming a bullish cup and handle pattern formation, giving a breakout. This is a continuation pattern, basically meaning that the trend is going to be strong for next few weeks as well. One can keep a stop of 8,200. Target would be 9,200. Second recommendation, buy on CTSE. Stock is coming out of consolidation. Decent amount of addition is seen in the FNO space. Hourly charts have seen breakout. First of all, 810, 855 is what I would bring.
Okay. Rajesh, what about you? Any more buy calls that you're looking at?
Yeah, my first buy call would be on McDowell. If you look at the structure, stock managed to give breakout of a down sloping trend line on the daily chart, and looking at the structure and looking at the addition on the open interest, I feel that stock can rally towards 654 in the near term basis. So one can buy McDowell with the stop loss of 630. Another buy would be on CSC. If you look at the pattern of the CSC, stock is forming higher top higher bottom formation on the daily chart, and looking at the breakout on the near term chart, and looking at the open interest, huge open interest addition in the stock in today's trade, I feel that stock can rally towards 850 in the near term basis. So one can buy with a stop loss of 820 on the CSC. And third pick would be on the Pharma Pack and Dr. Reddy. We have seen in the initial half of the day, we have seen some negativity, but again we have seen a lot of buying action at the lower level, and looking at the recovery and looking at the weekly setup, I feel that Dr. Reddy can move further from the current level towards 2850. So one can buy with a stop loss of 2775 on the Dr. Reddy.
Great. Okay. Samit also joining us. Samit, from on your list, then what's looking good?
See, clearly the overall bias has to be positive. We have two buy recommendation. The metal space, which has been buzzing since last couple of days, it appears that it is out of a slumber. So today we are seeing a good follow-up move. So JSW is the one stock that has given a decisive breakout, price and volume breakout from its recent concession. We expect continuation of this one. Stock has already moved a lot, but we still believe that there's further steam left in this counter. So this stock can be bought at current level. Minor dip would be a good buying opportunity. 243.4 would be a stop loss level, and the immediate target to watch out for would be around 262 to 65. Apart from this, the auto ancillary space has been doing well since last couple of weeks. So Motherson Sumi is the one stock. Last week we saw a decisive breakout from its consolidation somewhere around 118, 119. Stock has already given decent bump up, and then after a consolidation of nearly 3-4 days, stock is now resuming its uptrend. We expect this stock heading towards 134, 136. Can be bought at current level. Stop loss would be around 121.4.
Right. Yeah, thanks so much for joining us, Rajesh. Thank you as well. We've still got Samit and Gaurav with us. We'll continue to get you some more strategies after a very quick break.